Welcome to the third presentation in the Nuwaru and Airwallex series on businesses scaling up. I'm Peter Chiswell. I'm a partner at Nuwaru and a corporate tax specialist. And today I want to talk to you about the issues you'll confront when you're looking to raise funding for your business. The first question I want to look at is debt or equity. What are the tax aspects you need to consider, and is there a balance that you can strike between the two? Next, I'll look at the tax tips and traps with raising debt as opposed to equity. What drives that decision between raising equity versus debt? If you're looking to get funding from offshore, there are some other interesting issues you need to consider, and I want to run through some of those, such as transfer pricing, thin capitalisation, and withholding tax. And finally, if you're planning for an exit, I want to look at the steps that you can take to set up your business for that future sale or IPO. But first, it's always important to start with the basics. Why would you want to raise equity? There's no recurring interest expense, typically no need to repay. There's flexibility around payouts, and that's quite an important issue because you can manage cash shortfalls by delaying or suspending dividends. Equity can form the foundation of an employee share scheme, and David went through those issues in session 2. It's quite important. Now, equity requires more formality. Through a properly drafted constitution and shareholders agreement, you can manage some of those, and in many ways it might be better than dealing with banks. And just from a tax aspect, dividends are not deductible, but they can be franked. Alternatively, why debt? There's flexibility. Obviously, you can raise cash whenever you need it. You can claim a deduction for the interest, provided the debt is raised in relation to your business. And through that, interest deductions can create tax losses, and that's a theme I'm going to come back to and again in this presentation, because there are some important considerations around tax losses, and particularly if you are heading off to a sale or IPO in the future. Obviously, having an interest obligation requires more rigour around tax management than paying dividends. From the investor perspective, what's important? Well, an investor who wants to come in for growth and take the risk of loss is clearly going to be driven to an equity investment. Equity is illiquid, at least until there's a listing or sale, so they're in there for the long haul. From a tax perspective, the dividends are tax effective, provided they are franked, and they're franked to the extent that tax is payable. And again, that's an issue that we'll come back to. And conversely, interest is accessible in the hands of a lender. So is there a right mix? And unfortunately, the answer to that is, well, it depends. And the sort of things you need to weigh up are, what are the investor preferences and what are their tax profiles? And from your side, what's your profitability and cash forecasting telling you? And what is your tax profile? You've got to weigh all those things up. But one thing that is important to think about always is to optimise the tax positions of both the business and the investors where you can. And quite often that means putting debt and therefore the interest deductions in the hands of the higher taxpayer. And quite often that's the individual investor, not within your own corporate structure. And it is also a consideration for you avoiding trapping and wasting tax losses. And again, that's an issue I want to come back to. So what are the tax considerations with raising equity? The first one is actually characterisation, which is a bit of a geeky tax issue, but it's very important. Is your share actually a debt interest for tax? The terms debt interest and equity interest are defined in the tax law. And what is legal form debt might end up being equity for tax purposes. And what is equity in legal form could actually be treated as debt. For example, debt can include things like redeemable preference shares and convertible notes if they have certain characteristics of debt, such as a non-contingent return, or there's virtual certainty that you'll get your money back. If your interest is actually a debt interest and an equity interest, and that's possible given the way the tax definitions work, then the tiebreaker is debt. you'll be treated as having a debt interest. And that can actually be quite a nasty surprise for a shareholder who receives a return and discovers he's not getting franking. What this boils down to is if you're looking at anything other than a vanilla instrument, you should get some expert tax advice and get the documentation of the instrument right. The second issue I want to talk about is franking, which, as I said before, reflects tax paid by the corporate group, which is quite a simple concept. But there is complexity in the timing issues here, because the benefit of certain incentives can actually evaporate at the shareholder level if claiming deductions for those incentives, like accelerated depreciation or R&D, those deductions means you don't pay enough tax and therefore you can't frank the dividends to a full extent. The next issue is one that comes up if you are raising funds from offshore. If you're paying dividends to a shareholder offshore, then if you frank it, there's no withholding tax, but there is essentially some wastage of the franking credits by doing that. 10% withholding tax versus 25% or 30% corporate tax. So there is a wastage element to consider. If you're in a Australia-New Zealand context, there is a trans-Tasman credit system where, for example, an Australian company can pass imputation credits onto its New Zealand-based shareholders and vice versa. But it's probably a fairly marginal thing, but it is there if you need to use it. So they're the main issues with equity. Now, what are the tax considerations we need to think about for debt? And the first issue is the one I've said I'm going to come back to, and here we are, tax losses. Interest deductions and tax incentives and operating losses can all create or increase tax losses. And these are valuable things. There's a future cash flow benefit in the ability to carry a loss forward and claim it against income of future years. So you really want to make sure that the unutilised losses are preserved in future years. The trap here is that losses can actually be trapped themselves in a corporate or trust structure. In fact, if it's a trust structure, they're almost certainly going to be trapped in that structure unless the trust can generate enough income in future to utilise the losses. In a corporate environment, consolidation can assist, and I know James talked about consolidation in session 1. Consolidation helps because you can apply losses around entities within that consolidated group. But there's a risk here when ownership changes, and that is an issue that I'll look at when we talk about sale or IPO. The bottom line being that although these losses may have benefit to you, the purchaser of your business may not see the benefit and may not value the benefit. So you need to therefore think about where the deduction best sits. It may be preferable, for example, to borrow at the shareholder level, or the level of the investor, where the tax deduction can be utilised and you don't actually create the tax loss in the corporate group. If you're obtaining debt from offshore, there are a few other things to think about. Thin capitalisation is a very complex tax issue, but at its essence, it is a potential restriction on interest deductions. But it's only going to be an issue for you where your group is controlled from offshore or you control investments offshore, and control being a 50% or more test. In addition, the rules won't cut in until your interest deductions are $2 million or more. And then on top of that, there are safe harbours based on debt to equity ratios, which give you some room to move before you strike this problem. It's therefore not necessarily an issue for you, but it's definitely something to watch as you scale up. If you're accessing debt from offshore, the next issue you need to think about is withholding tax on the interest payments. 10% withholding tax is deductible on payments out. Now make sure you understand your risk, because if the documentation that you have with your lender has a gross up clause in it, that can increase the cost to you by the 10%. And obviously having a tax obligation to deduct the interest is something you need to manage and not, obviously, not miss. The third offshore aspect I wanted to briefly talk about is transfer pricing, which has its arms around everything to do with offshore tax. But at its essence, if you're dealing with related parties, you need to deal on arm's length terms and have market rates for debt. And very importantly, have documentation to support the positions that you're taking. Transfer pricing isn't generally an issue if you're not dealing with related parties, unless their dealings themselves are uncommercial. So just it may not be an issue for you, but bear it in mind. So we've talked about the tax issues with debt and equity. Now I want to cover the last topic, which is how do you structure for a sale or an IPO? And this really brings everything together that has been covered by James in session 1, David session 2, and what I've dealt with already. The first issue you need to think about, get the structure right up front. And it comes down to, do you need a holding entity? Now, James discussed these issues. He talked about having a sales company, a service entity, an entity that holds the IP as separate entities, and the reasons why you might want to do that. But he also talked about putting a holding company on top, and the reason there is that you can access tax consolidation, which is a very powerful tool, as he covered in his presentation. Look, many of you may already be there, but if you're not, it's very important that you get there and put the sale perimeter under a single entity. Makes your life much simpler when it comes to sale or IPO. But in the process of getting there, make sure that you avoid unnecessary tax leakage. And what I'm talking about here is accessing CGT rollover relief, stamp duty restructuring relief where you can, restructure where you can within a tax consolidated group, because it's pretty much a free-for-all within the consolidated group. You can transfer things around without any tax consequences. But on the other side of that is clear the decks. If there are aspects of your business that aren't part of the sale perimeter, then obviously you need to clear them out, and do that if you can, accessing rollover relief, stamp duty relief, whatever you can to minimise the tax impact of doing that. The next issue I want to talk about for sale, IPO, is employee share schemes. If you don't have one, it can be quite a powerful tool and incentive to have one. So it will enable your employees to share in the upside of the sale or the IPO. David talked, I know, at length about what you need to do, what you need to think about in relation to employee share schemes, so I won't cover that territory, but it is definitely something to think about. Perhaps the new aspect here, the different aspect here, is what happens on a sale, and consider whether you need to change the plan rules in any way. And what I'm thinking about here is, do you have a new class of employees who are entitled, who you want to benefit or incentivise under the plan? Do you have a different class of investors, which means you might have a different class of share that you want to build into the plan? All important things that you need to think about upfront. The next issue, probably close to your hearts, don't forget the tax consequences for founders and the other investors. Founders and investors can face big tax bills if they're selling shares. They're probably working off a really low cost base, and there should be some real business in your business. So rather than trigger that, think about issuing new shares to the incoming investors rather than a sale, and do that at market value. And by doing that, you can avoid tricky value shifting rules that we have in tax, and it can give a much better outcome for the investors. Then you need to consider the impact of a change in ownership on the tax losses. And I'm pretty sure it's the last time I'll come back to tax losses, but this is where the rubber really hits the road. When the underlying ownership of an entity changes by 50% or more, losses carried forward are placed at risk. You won't get the deduction unless you're able to demonstrate that you carry on the same business or a similar business under the tax rules. So you'll need to work with the new owners to manage this risk. And the problem is that it actually may run counter to their business plans. And they're buying the business, they might want to take it off in a different direction. And if you do that, you're definitely putting those losses at risk. And what that means, of course, is that the investor or the purchaser may not put the value on the losses that you want them to put on them, because they know they will understand the tax and they'll understand the issue if they're going to change things around. Finally, I think it's a fairly obvious point, but make sure your tax compliance is up to date. It's incredibly easy for issues like this to derail a due diligence and delay or even terminate a transaction. I'm talking about tax returns, your BAS, PAYG, superannuation payments, all those things. Keep them up to date. Be ready for the sale. Have all your systems and processes in place. They're actually all the issues I wanted to cover. Thank you for your attention, and we'll see you at our live webinar, which is coming up soon. Thank you.